Welcome back to the deep dive. This week, we're diving into Bitcoin. It just had a monumental week.
It did.
You've probably seen all the headlines about Bitcoin hitting $100,000, that eye-catching, six-figure mark. But we're going to go beyond the surface here.
Absolutely.
To really understand what's driving this surge.
Yeah, that six-figure price is certainly attention-grabbing, but the real story lies in the data.
Yeah.
Both from expert analysis and what we see happening on-chain.
Mm-hmm.
That's where we find the true insights.
Okay, so we've got a stack of fascinating reports here. Analysts like Crypto Fella are sending out some cautionary signals, while others like Axel Kibar are practically dismissing the $100,000 milestone altogether.
Yeah.
Plus, we've got some interesting numbers from CryptoQuant about how long-term Bitcoin holders are reacting to this price action.
Exactly. We're going to break down these different viewpoints and dig into that on-chain data and see if we can decipher what it all means for the future of Bitcoin.
All right, let's start with the elephant in the room, Bitcoin's record-breaking week. It closed above $98,000 on November 24th, marking its highest weekly close ever. November shaping up to be Bitcoin's best month in 5 years. And Q4 is already boasting gains of over 54%.
Wow.
So it's a bull market out there.
It certainly is.
Yeah.
But amidst all this excitement, it's crucial to remember market psychology.
Yeah.
That $100,000 mark is, in many ways, a psychological barrier, a perceived milestone.
Yeah.
And while it doesn't necessarily hold any inherent technical significance, it can have a real impact on how investors behave.
So it's like everyone's waiting with bated breath for that magic number to be hit, and then what? Does that create a self-fulfilling prophecy?
It can. And that's why we see analysts like Crypto Fella issuing warnings about a potential correction after such a strong run.
Right.
They're suggesting that a pullback might actually be healthy for the market in the long run.
Okay, so a reset button before the next leg up.
Right.
But what's interesting is that some analysts like Axel Kibar are basically saying, $100,000, who cares?
Right. Kibar argues that it's not a significant technical level and dismisses its psychological weight. He even joked that it might just be a nice round number for posting memes and celebrating. Which, makes you wonder, are we all just a bit obsessed with round numbers?
Yeah, it's like we can't resist the allure of those big round milestones. But if someone like Kipar, who's deeply entrenched in the technical analysis of Bitcoin, is saying it's not a big deal, shouldn't that give us pause? Maybe we need to shift our focus from the price ticker to something more substantial.
I think that's a smart approach.
Yeah.
If we want to truly understand what's happening with Bitcoin, we need to look beyond the surface level excitement of price milestones and delve into the on-chain data. That's where the real insights lie.
Okay, so let's dive into that on-chain data. What's it telling us about how long-term Bitcoin holders, those who've weathered previous cycles and market swings, are reacting to this surge?
Well, the data from CryptoQuant reveals that these long-term holders, often called diamond hands in the crypto community, are taking profits at record levels. On November 22nd, they realized a staggering $443 million in aggregate profits.
Whoa, $443 million. So veteran Bitcoin holders are cashing out. Does that mean they think the bull run is about to end?
Not necessarily. What's important to understand here is that this kind of profit taking is actually typical in bull markets. It's not necessarily a bearish signal.
So explain this to me. Why would seasoned Bitcoin investors, who presumably believe in its long-term potential, start selling off their holdings during a period of price appreciation?
It's all about market cycles. You see, long-term holders tend to accumulate Bitcoin during bear markets when prices are low. Then as the market heats up and prices rise, they strategically take profits, securing gains, maybe reallocating capital. This behavior actually suggests a deep understanding of how Bitcoin markets tend to move.
So instead of signaling panic or a lack of faith in Bitcoin's future, this profit-taking by long-term holders might actually be a sign of their confidence in the cyclical nature of the market.
That's exactly. They're capitalizing on the current bull run while remaining aware that markets don't go up in a straight line forever. It's a savvy approach to managing risk and maximizing returns.
Okay, that makes sense. So we've got long-term holders taking profits, which isn't necessarily a bad thing. But what about those who are newer to the Bitcoin game? What are the short-term holders doing? Are they showing any signs of anxiety or, FOMO?
That's a great question. It leads us to an important on-chain metric called the Spent Output Profit Ratio, or SOPR for short. SOPR essentially tells us whether, on average, Bitcoin holders are selling their coins at a profit or loss.
Okay, got it. So what's the SOPR saying about the short-term holders right now? Are they riding the wave of optimism, or are they starting to get a bit skittish?
Well, the current 30-day moving average for the short-term holder SOPR is sitting at 1.02, And what's interesting is that historically, when this level is reached during a bull market, it often precedes a pullback or a correction.
Wait, a correction? That doesn't sound too fun. So are you saying that those who bought Bitcoin more recently, who haven't experienced the full roller coaster ride of a market cycle, are getting a bit jittery and might be contributing to a potential dip in price?
It's a possibility, and it's something worth paying attention to. But before we spiral into a vortex of fear about corrections, let's remember that corrections are a natural part of market cycles. They're like a deep breath before the next climb, a chance for the market to consolidate before continuing its upward trajectory.
So we've got long-term holders strategically taking profits, potentially indicating a belief in Bitcoin's long-term growth, while short-term holders might be showing signs of nervousness, potentially contributing to a short-term correction. It's like a fascinating dance between experience and anticipation, playing out on the on-chain stage. But there's another group of players we haven't talked about yet. The institutional investors, don't they have a role to play in all of this?
Absolutely. And their entrance into the Bitcoin arena has been one of the most significant developments in recent years. We're talking about the rise of Bitcoin ETFs, or exchange-traded funds, which have opened the floodgates for institutional money to pour into the crypto market.
Okay, so for those who might not be familiar with ETFs, could you give us a quick breakdown of what they are and why they're such a big deal for Bitcoin?
Essentially, a Bitcoin ETF is an investment fund that tracks the price of Bitcoin, making it much easier for institutional investors like pension funds and hedge funds to gain exposure to Bitcoin without having to directly buy and hold the cryptocurrency itself. It's like a simplified way for big players to get skin in the game.
So it's like a bridge between traditional finance and the crypto world.
Exactly. And what's remarkable is the sheer volume of capital that has flowed into these Bitcoin ETFs. In just the 5 trading days leading up to November 22nd, they saw a record-breaking $3.35 billion in net inflows. That's more than any other week in history.
$3.35 billion in just 5 days. That's a mind-boggling amount of money. But how does this massive influx of institutional capital impact the dynamics we've been discussing, with long-term holders taking profits and short-term holders potentially triggering a correction?
That's where things get really interesting. You see, this unprecedented demand from institutional investors, fueled by Bitcoin ETFs, could actually act as a counterbalance to the selling pressure from long-term and short-term holders. It's like a tug-of-war between profit-taking and fresh capital pouring into the market.
Okay, I'm starting to see the picture here. So it's not just a simple equation of long-term holders sell, price goes down. There's this powerful force of institutional money entering the market through ETFs, potentially offsetting that selling pressure and even pushing the price higher. But how do we know which side will win this tug-of-war?
That's the million-dollar question, isn't it? And it's one we'll explore further as we continue our deep dive. But before we move on, there's one more element we need to consider: the macroeconomic landscape. What's happening in the wider world of finance that could impact Bitcoin's wild ride?
Right, because Bitcoin doesn't exist in a vacuum, right? It's part of a larger interconnected financial system. So what's on the horizon in terms of macroeconomic events that could shake things up, not just for Bitcoin, but for markets in general?
Well, here in the U.S., we're heading into Thanksgiving week, which means a slightly shorter trading week, but also some potentially significant economic data releases that could inject a dose of volatility into the markets.
Oh boy, data releases. Those always seem to make things interesting, to say the least. What kind of data are we talking about here? Give us the rundown.
Well, we've got the minutes from the Federal Reserve's November meeting where they decided to cut interest rates. We'll also be getting the Personal Consumption Expenditures Index, or PCE Index, which is the Fed's preferred measure of inflation. A key data point that everyone will be watching closely. And of course, we can't forget the unemployment data, always a crucial indicator of economic health.
So basically a whole buffet of economic data that could give us some clues about the direction of the U.S. economy, which, as you mentioned, can have ripple effects across all markets, including crypto. It's like trying to decipher a complex puzzle where each piece influences the others. But before we get lost in the labyrinth of macroeconomic data, let's take a step back and recap what we've uncovered so far in our Bitcoin deep dive.
Yes, let's synthesize what we've learned.
We started with the excitement surrounding Bitcoin hitting that psychologically significant $100,000 mark, but we quickly shifted our focus from the hype of price milestones to the more nuanced story unfolding in the on-chain data.
Exactly.
We learned that long-term holders, those seasoned Bitcoin veterans, are taking profits. But this isn't necessarily a sign of panic or belief that the bull market is over. It could actually reflect their understanding of market cycles and their confidence in Bitcoin's long-term potential. Then we saw that short-term holders, those who might be newer to the Bitcoin game, are showing some signs of jitteriness, which could contribute to a short-term correction. But even with this potential for a dip, there's a powerful counterforce at play: the massive influx of institutional money through Bitcoin ETFs.
These ETFs have opened the floodgates for institutional investors, and the sheer volume of capital they're pouring into Bitcoin could offset any selling pressure from long-term or short-term holders. It's like a tug-of-war between experience, anticipation, and the growing influence of traditional finance in the crypto space.
And to make things even more interesting, we've got this backdrop of macroeconomic data releases coming up that could add another layer of complexity and volatility to the mix.
It's a multidimensional puzzle, that's for sure. But by piecing together these insights from expert analysis, on-chain data, and macroeconomic trends, we can start to develop a deeper understanding of what's driving Bitcoin's current trajectory and what might lie ahead.
Exactly. And on that note, before we move on to the next part of our deep dive, I want to leave our listeners with a thought-provoking question to ponder. If these ETFs continue to attract record inflows, could that be the catalyst that propels Bitcoin past $100,000 and beyond, even if we encounter some choppy waters along the way? And what does this tell us about the evolving relationship between institutional investors and the world of crypto?
Those are excellent questions. And ones that I'm sure many of our listeners are grappling with right now. We'll explore those and more when we return for part 2 of our Bitcoin deep dive.
Stay tuned.
Welcome back to our deep dive into Bitcoin's wild ride.
We left off talking about the potential impact of those massive ETF inflows, even in the face of some, uncertain macroeconomic conditions.
Right, and that's where things get really intriguing. If we look at the historical data, Bitcoin has often been seen as a hedge against traditional market turmoil. When stocks are down and investors are looking for alternative assets, Bitcoin is often, shown.
So it's like a digital safe haven.
In a way, yes, but it's not that simple. Bitcoin is still a relatively young asset, and its correlations with traditional markets are evolving. We've seen periods where it's moved in tandem with stocks, and other times where it's gone its own way.
So how can we make sense of all of this? It seems like Bitcoin is constantly defying expectations and zigging when everyone expects it to zag.
It's true that Bitcoin can be unpredictable, but that's part of what makes it so fascinating. The key is to remember that Bitcoin's price is influenced by a complex interplay of factors: technological innovation, regulatory developments, investor sentiment, and, yes, macroeconomic trends. There's no single magic bullet that explains its every move.
It's like trying to solve a multidimensional puzzle where the pieces keep changing shape. But you mentioned that institutional investors are becoming more involved in the Bitcoin space. Could their behavior be a key to understanding how Bitcoin interacts with traditional markets?
I think that's a very astute observation. As institutional investors become more comfortable with Bitcoin, we're likely to see a deeper integration between crypto and traditional finance.
Okay, so what does this deeper integration actually look like? Paint me a picture.
Well, for one thing, it could mean that Bitcoin becomes more sensitive to macroeconomic data releases, interest rate decisions by central banks, and even geopolitical events. Think about it. If institutional investors are holding Bitcoin as part of their diversified portfolios, they're going to react to macroeconomic shifts just like they would with any other asset.
That makes sense. So as Bitcoin becomes more intertwined with traditional markets, those external forces, the things happening in the wider financial world, are going to have a bigger impact on its price.
Precisely. And that's why staying informed about macroeconomic trends is becoming increasingly important for anyone who's serious about Bitcoin, whether you're a seasoned trader or just starting to dip your toes into the crypto waters.
So it's not enough to just follow the price of Bitcoin. You need to understand the forces that are shaping the entire financial landscape. It's like zooming out to see the bigger picture.
Exactly. Now, speaking of understanding the bigger picture, I want to circle back to something we touched on earlier, the idea of Bitcoin market cycles. You mentioned that long-term holders tend to take profits during bull runs, which can sometimes lead to corrections. But how do we know when a bull run is coming to an end? Are there any signals or indicators that can help us navigate these cycles?
That's the million-dollar question, isn't it? Everyone wants to know how to time the market perfectly, to buy low and sell high. But is that even possible with Bitcoin?
Well, there's no foolproof way to predict market tops and bottoms. If there were, we'd all be millionaires by now. But there are some historical patterns and on-chain metrics that can give us clues about where we might be in a market cycle.
Okay, spill the tea. What are these magical metrics that can help us decipher the mysteries of Bitcoin cycles?
One metric that's often cited is the Mayer multiple, which compares Bitcoin's current price to its 200-day moving average. Historically, when the Mayer multiple reaches certain levels, it's often a sign that the market is overheated and due for a correction.
So it's like a temperature gauge for the Bitcoin market. When the Mayer multiple gets too high, it's a sign that things are getting a bit too hot and a cool down might be on the horizon.
You could think of it that way. But it's important to remember that no single indicator is perfect. It's crucial to consider a confluence of factors before making any investment decisions.
Right. It's like checking multiple weather forecasts before deciding whether to pack an umbrella. So I've got the Mayer multiple on our radar. What other metrics should we be paying attention to?
Another interesting metric is the net unrealized profit loss, NUPL indicator, which measures the overall profit or loss held by Bitcoin investors. Essentially, it tells us how much in the money Bitcoin holders are on average.
Okay, and how is that helpful in understanding market cycles?
Well, when NUPL reaches certain thresholds, it can indicate periods of extreme greed or fear in the market. For example, if NUPL is very high, it suggests that a large percentage of Bitcoin holders are sitting on significant profits, which could create a scenario where a small dip in price triggers a cascade of selling as people rush to lock in those gains.
So it's kind of like a sentiment gauge for the Bitcoin market. High NUPL means euphoria and a potential for a reversal, while low NUPL might signal fear and capitulation, which could be a buying opportunity for those with a strong stomach and a long-term perspective.
Exactly. Understanding market sentiment is crucial for anticipating potential shifts in price direction. It's like reading the mood of the crowd to get a sense of where things might be headed.
This is all starting to sound like a crash course in technical analysis, but I'm starting to see how these on-chain metrics, combined with an understanding of market cycles and macroeconomic trends, can paint a much richer picture than just staring at the price of Bitcoin all day.
That's the power of the deep dive. We're not just scratching the surface, we're digging into the underlying forces that shape the crypto landscape.
Now, before we wrap up this part of our deep dive, I want to leave our listeners with one final thought-provoking question. We've talked about Bitcoin's potential as a safe haven asset, its growing integration with traditional finance, and its unique market cycles. But if Bitcoin continues on this path of mainstream adoption, will it lose some of its decentralized, rebellious spirit? Or could it actually bring the benefits of blockchain technology to a wider audience? Is it a trade-off between idealism and impact?
That's a question that deserves its own deep dive. It's something we'll continue to explore as the Bitcoin ecosystem evolves. But it's a crucial question to ask as we consider the future of not just Bitcoin, but the entire crypto space.
It's a reminder that technology is never neutral. It's shaped by the people who create it, the people who use it, and the values that drive its development.
Exactly. And as we head into the final part of our deep dives, let's keep that question in mind. We'll explore the broader implications of Bitcoin's evolution and consider what it means for the future of finance technology and the very idea of decentralized systems.
Stay tuned, folks. We'll be back in a moment for the final chapter of our Bitcoin saga. Welcome back to the final part of our Bitcoin deep dive.
It's been quite a journey, hasn't it? From record highs to on-chain insights, from institutional inflows to macroeconomic anxieties, we've covered a lot of ground.
We sure have. And as we wrap up, I think it's important to emphasize that Bitcoin's story is still being written.
Absolutely. What we're witnessing is the evolution of a revolutionary technology and a new asset class. There will be bumps along the way, periods of volatility, and moments of uncertainty.
That's true of any emerging technology or asset class, right? It's all part of the process of growth and maturation. But despite the inevitable ups and downs, are there any constants, any fundamental principles that underpin Bitcoin and have driven its remarkable rise?
Yes. Even amidst the constant change and evolution, there are core principles that remain at the heart of Bitcoin: decentralization, transparency, and scarcity. These are the pillars that have underpinned its journey so far and will continue to shape its future.
Okay, so let's unpack those principles a bit. Why are they so crucial to Bitcoin's identity and its potential impact on the world?
Let's start with decentralization. Unlike traditional currencies, which are controlled by central banks and governments, Bitcoin operates on a decentralized network distributed across thousands of computers around the world. This means there's no single point of failure, no central authority that can manipulate the system.
So it's like a digital version of a checks and balances system designed to resist censorship and control by any single entity?
Exactly. And then there's transparency. Every transaction on the Bitcoin network is recorded on a public ledger called the blockchain. Anyone can view this ledger and trace the history of every Bitcoin. This transparency promotes accountability. It makes it incredibly difficult to engage in fraudulent activity.
It's like a public audit trail that ensures honesty and trust within the system.
Precisely. And finally, there's scarcity. Bitcoin supply is capped at 21 million coins. This built-in scarcity is a key differentiator from traditional fiat currencies, which can be printed endlessly by governments, leading to inflation.
So Bitcoin is designed to resist the kind of inflationary pressures that can erode the value of traditional currencies over time.
Exactly. These three pillars, decentralization, transparency, and scarcity, form the foundation of Bitcoin's appeal and have fueled its growth as a store of value, a medium of exchange, and a potential catalyst for broader financial innovation.
So even as Bitcoin's price fluctuates and the market grapples with short-term trends, these core principles remain constant, anchoring its long-term value proposition.
Precisely. And as we reflect on our deep dive into Bitcoin's big week, I think the biggest takeaway for our listeners is this. Don't get caught up in the hype of price milestones or short-term fluctuations. Focus on understanding the fundamentals, the technology, and the long-term potential of Bitcoin.
It's about looking beyond the headlines and diving deeper into the data, the analysis, and the forces that are shaping this fascinating space.
Exactly. And that's what we've tried to do in this deep dive. We've given you the tools and insights to form your own informed opinions about Bitcoin.
Because ultimately, the best way to navigate the world of crypto is to become a lifelong learner, a critical thinker, and a curious explorer.
Well said. And on that note, I want to leave our listeners with one final thought. As Bitcoin continues to evolve and mature, its impact will extend far beyond the realm of finance.
That's an intriguing idea. Tell us more.
Imagine a world where blockchain technology empowers individuals, disrupts traditional industries, and creates new forms of value.
A world where financial inclusion is expanded, supply chains are made more transparent, and data privacy is enhanced.
Exactly. Those are just a few of the possibilities that Bitcoin and blockchain technology hold. And it's up to each of us to explore those possibilities, to challenge the status quo, and to build a future that is more equitable, transparent, and innovative.
That's an inspiring vision, and it's a reminder that we're all part of something bigger than ourselves. We're witnessing the birth of a new era, and it's an exciting time to be alive.
It certainly is. So let's embrace the unknown, keep learning, and see where this incredible journey takes us.
Thank you for joining us on this deep dive into Bitcoin's big week. Until next time, stay curious, stay informed, and stay engaged. This is just the beginning.